Mortgage Dr. Rich here with part one of a two-part video production talking about LTV, CLTV, and TLTV. Now, in this video, I'm going to discuss LTV or loan to value. And this is an extremely important concept to be understanding of so that you can act and perform effectively as a mortgage professional. Because even if the borrower is qualified, if something happens and they no longer are able to pay their mortgage, the lender will have to foreclose on, repossess the property. Well, that's why how much equity or skin in the game the borrower has is important, because the more skin in the game, the less likely they will be to default. So let's take a look at loan to value. First of all, loan to value represents the lender's ownership interest in the subject property expressed in the form of a percentage. So let's say that somebody purchases a home for $100,000, the purchase price and appraised value of which is $100,000, and they finance it with a mortgage for $90,000. Well, as long as the lender is owed $90,000, that lender has a $90,000 ownership interest in the subject property. Now, the borrower's ownership interest is $10,000, because if the purchase price and appraised value is 100 and they finance it with 90, they have $10,000 worth of equity in the property. So in this case, since $90,000 is 90% of the purchase price and appraised value, the LTV is 90%. Since the ownership equity, the owner's equity is $10,000, which represents 10% of the subject property's purchase price and appraised value, we'll say that the borrower's equity is 10%. When there is one lien on a property, and this is extremely important to conceptualize, when there is one lien on a property, LTV plus equity will always equal 100%. When there's one lien on a property, LTV plus equity will always equal 100%. And if the loan is amortizing, with every payment that's made, the LTV goes down and the equity goes up. But all throughout this process, the LTV allocation plus the equity allocation together will always equal 100%. So how do we go ahead and calculate LTV? Well, it's relatively simple when you think about it. On a purchase transaction, LTV is calculated by dividing the loan amount by the lesser of the subject property's purchase price or appraised value. Just because the home is being purchased for $100,000 does not mean that it's going to appraise for $100,000. It certainly could, but it could also come in higher or lower. So to prevent a borrower from potentially taking advantage of artificially inflated equity on a purchase transaction, we calculate the LTV as the loan amount divided by the lesser of the subject property's appraised value or its purchase price. Okay. On a refinance transaction that's seasoned, LTV is simply calculated by dividing the loan amount by the subject property's appraised value. But if it's a refinance that is not seasoned, and by that I mean that for whatever reason there is, the borrower is opting to refinance a mortgage on a property that they've owned for less than 12 months, and that makes it non-seasoned. So in a non-seasoned refinance scenario, to once again prevent the borrower from potentially taking advantage of artificially inflated equity, LTV is calculated by dividing the loan amount by the lesser of the subject property's current appraised value, original appraised value, or original purchase price. So in a nutshell, that is LTV. Please follow, like, share, whatever you need to do to learn more about all the other things I teach about mortgages. And please don't hesitate to visit www.nmlstraining.com to see all the products and services that you can get to help you achieve success on the NMLS exam and beyond in your mortgage career. Bye.